Good morning, everyone. Welcome to Jeff's World, the weekly 30-minute show where, as always, our goal is to help you make more informed investment decisions. Now, we're going to cover a lot of opportunities and risks for investors today, and we want to take your live questions from the chat on YouTube so you can ask us what's on your mind at any time by entering it into the chat, and we'll get to those questions in a few minutes after we share some of our latest insights. Now, we've got a lot to cover, but we've got a few required disclosures before we get started. Of course, we don't know you personally, so we don't make personalized recommendations about your personal situation, but we do generally talk about markets and sectors and areas of investing we think are likely to perform well or poorly, and why, though we don't provide an outlook for specific stocks. And things can and do change, so all the thoughts we share are subject to change as well. And of course, investing is risks, and international investing has unique risks like currency moves, so please keep all that in mind. Now, as is the case every week, I'm joined by Michelle Gibley and Heather O'Leary on the global strategy team at Charles Schwab. Good morning, ladies.
Good morning, Jeff. Good morning, everybody.
Good morning, everybody. As usual, I will be watching the chat and the questions closely, and we will get to those in a little bit. Jeff, go ahead and kick us off with a rundown of what we are watching this week that could move the markets.
Yeah, it's often the things that we don't know that are coming that move the markets, but I'll tell you what we are watching that could move the market. So on Monday here, we've got China's retaliatory tariffs on U.S. goods scheduled to take effect. And we've got presidents of both countries seeking talks, but neither seem to be in a big rush right now. So those are likely to go into place and may linger for a bit. We're also likely to see an announcement about reciprocal tariffs this week. And we got news about steel and aluminum tariffs on Sunday, but no specifics on implementation. Maybe more of that comes today. Metal tariffs, though, are not new and not hurting the market this morning. On Tuesday, we've got Fed Chairman Powell giving his semi-annual monetary policy testimony to the Senate Banking Committee, and on Wednesday to the House Financial Services panel. A lot of questions there. I'm sure will be posed to him about, is he done hiking rates? Is he going to have to, or done cutting rates? Is he going to have to cut more? Is he going to hike eventually? All that will be potentially market moving. President Trump actually commended the Federal Reserve for its decision to leave interest rates unchanged in January. So we'll have to see how those lines of questioning go around all of that. There's, of course, the potential for inflation-inducing tariffs is a further reason for the Fed to stay on hold for now. I imagine Chairman Powell might get asked about tariffs. On Wednesday, we get inflation, the U.S. CPI for January. Economists are expecting inflation to remain at 2.9% from a year ago. Same as in December, still well above the Fed's 2% target. And with tariffs seemingly already prompting some businesses to raise prices. We've seen that from U.S. steelmakers. We heard from U.S. Steel, they were raising prices by $50, I think Nucor 25. The outlook for inflation remains somewhat elevated, to quote Chairman Powell from his press conference on January 29th. Again, tariffs will probably be a big part of that discussion that we hear from the Fed or in the middle of this week. Now, on Friday, we're going to get fourth quarter GDP for Europe. The Eurozone is expected to have stalled, with the region's two largest economies, Germany and France, actually having contracted during the quarter. That data could get revised, but so far, negative prints for Q4 for Germany and France. Economists do expect a rebound in 2025, so we'll see that the components of that drag on growth in Q4 and whether the ingredients are coming together for an economic rebound if in 2025 for Europe. Now, we've also got a large slate of companies due to report this week. Guidance on future earnings growth may be mixed. We've got warnings potentially similar to what we heard from Ford last week on their earnings call when they highlighted the impact of autos. Remember, autos are Mexico's biggest export to the U.S. And who does that exporting? Ford and GM. A bunch of U.S. headquartered businesses and their operations in Mexico are the biggest producers of those vehicles exported to the U.S. So they're the ones in the crosshairs of those tariffs. So we may hear more about that as we go through the earnings season, some of those big manufacturers that operate in Canada and Mexico. In fact, it may seem that the U.S. holds all the cards on negotiations with Canada and Mexico, given their economic dependence on exports to the U.S. But let me elaborate on this. The exposure to companies is different than the economies. Yes, the Mexican economy exports a lot, and therefore its economy and exports are driven a lot by its dependence on the U.S. But if you take a look at the companies they're mainly U.S. companies. Like I mentioned, Ford and GM are the big exporters to the U.S. from Mexico. In contrast, a lot of Mexican businesses that have large U.S. sales come from their operations located in the U.S. that aren't subject to tariffs, like Cemex, which is a big Mexican cement maker. They don't make cement in Mexico and ship it to the U.S. They make it in the U.S., so not subject to those tariffs because it's not crossing the border. And I think, Heather, you did a great chart explaining this. Can you go through this for us?
Sure, I'm more than happy to. It's actually pretty simple. If you don't have sales to the US, you don't have a direct hit from tariffs. Four of the five Mexican stocks, which make up 50% of the MSCI Mexico index, are not likely to be directly affected by tariffs. That's because they serve the Mexican market. So for the top five, we have a bank, a Coca-Cola distributor, Walmart, and a telecom provider. Just one of the top five, the mining company Grupo Mexico, which you can see here on the chart, would be directly affected, having about a little over 20% sales to the US market.
That's brilliant. I love this chart so much, and I really think it's so insightful. It's easy to have this knee-jerk reaction, as the market did when those tariffs were announced. What was that, 2 Mondays ago now? 3 Mondays ago? I can't remember. Mexican stocks sold off tremendously and then rebounded as people processed this and went, wait, even if those tariffs go into effect, they didn't, they got delayed, but even if they did, it may not be as negative on stocks in Mexico. Sure, the economy may get hit, labor markets may get hit in Mexico, and that has wide ramifications. But just from a pure stock market perspective, few of the MSCI Mexico stocks would actually be hit by those tariffs. So really great illustration, Heather, and I'm sure it's a surprise to many investors. And that same scenario applies to Canada as well. Outside of energy exports, the largest Canadian exporters to the US are automakers. Yeah, Ford and GM, Stellantis, Toyota, Honda. Not Canadian companies. In fact, the biggest companies in the MSCI Canada Index are banks. They're not directly impacted by tariffs at all. And of course, energy companies, but they're facing reduced tariff rates. So that may help account for why the Canadian and Mexican stock markets continued outperforming the S&P 500 this year, even before the tariffs were delayed. I'm just going to pull up real quick. As of this morning, what are we looking at here in dollars? So we've got, Mexico stock market is up 8.3% in dollars this year. The S&P 500, 3.2. So, just an illustration of how impactful that can be. And look, since I'm already going into tariffs, let me dig deeper a little bit into it this week with a recap of where we are on all this. Since taking office, President Trump announced 25% tariffs on goods from Colombia, then subsequently dropped them before they were scheduled to begin. Of course, similarly, 25% tariffs on Mexico and Canada were also subsequently delayed, and a 10% additional tariff applied to goods from China did go into effect, but not the 60% tariff that was threatened on the campaign trail. So what's next for tariffs? With talk of new metals tariffs, these reciprocal tariffs, the looming end of the 30-day tariff delay on Mexico and Canada, and the administration's more comprehensive review of trade due on April 1st. Well, let me recap this for regions around the world. Real quick, we'll just go around the world. Canada, Mexico. So the delay in U.S. import tariffs on goods from Canada and Mexico until March by President Trump may be extended as the countries seem to be working to improve border security. And again, U.S. headquartered companies whose factories are the source of most of the exported goods from Mexico to the U.S. may seek to have their voices heard in Washington. But more complex negotiations may follow. We've got updates to the U.S.-Mexico-Canada agreement as Trump seeks to reduce trade imbalances there and the erosion of U.S. domestic auto production, and of course, keep Chinese companies out of Mexico. So there's more to come there in those negotiations, but the immediate threat of those tariffs is probably going to be extended beyond the start of March. At least that's our read. In China, 10% across the board increase in tariffs on goods from China will likely stay in place. China's limited retaliation seems designed just to avoid escalation rather than reverse what was just put in place. And that might be because China is more focused on domestic economic concerns rather than international trade and frictions there with the U.S. U.S. only direct exports to the U.S. make up only about 3% of China's GDP. A lot more, multiples of that tied to domestic consumption in China. That's where their focus is right now. Trump did refer to the 10% tariff announcement as an opening salvo, but we'll have to see what that means. we did have some executive orders signed by Trump on day one that included a directive to review the existing China 301 investigation and that 2020 phase one trade deal by April 1st, signaling that there might be some further U.S. actions may follow that. Now, China may respond with an offer to purchase U.S. goods or concessions on geopolitical issues like Russia, Ukraine. In the negotiations that may follow, I don't know what's going to come out of that, but it's not over yet. Excuse me. In Europe, to try to avoid U.S. tariffs on their exports, the EU has the ability to offer additional purchases of U.S. energy and defense products along with an increase in defense spending, kind of taking some of the burden off of the U.S. as it relates to NATO support, in addition to threatening retaliatory tariffs on U.S. services if they get hit with U.S. tariffs on goods. At this time, Trump has not specified a timeline for when he might announce tariffs against the EU. He might be waiting for the outcome of the German elections. That's on February 23rd. Germany is Europe's biggest economy, and it is the major auto exporter to the U.S. out of Europe, so he probably wants to see what's going on there before he engages in negotiations. The UK. When asked by a reporter earlier this month about UK tariffs, Trump said, look, I think that one can be worked out. He had basically there's a good relationship with the prime minister there, and they're just not real high on his list. So the UK is not a member of the EU, and Trump's response suggests the UK is way further down Trump's list. They may have an easier solution to avoiding tariffs than other major countries, and that may apply to Japan as well. Japan has a $70 billion trade surplus with the US, but the prime minister of Japan had a very friendly meeting with Trump over this past weekend, talking about what they can do to really help some of Trump's agenda. And in part, that was due to Japan's imports of U.S. energy, and they can scale that up. Japan is almost entirely dependent on imports for its energy. And Japanese manufacturers have considerable investments in their U.S. operations, which they can scale up. Japan is the top source of business investment into the U.S. That's data from the Bureau of Economic Analysis. So Japanese businesses investing in the U.S. more than any other country. So that's a plus as well. Now, Japan could still be hit by an across-the-board tariff, an idea Trump had floated on the campaign trail, but clearly it seems that the UK and Japan are much further down the list here in terms of tariff targets. So what's next? Well, I'd say given all of that, we want to keep in mind that we probably don't want to make investment decisions based solely on tariffs. Yes, I mentioned more may be coming and everything that's happened, but we can see how they can come and go fairly quickly. And the reality may be very different than the announcement. So all this serves as a reminder that we ought to be cautious about taking announcements at face value, let alone overhauling our portfolios or forecasts in response to them. But I would say, one maybe safer haven when it comes to investing, when it comes around all this tariff noise and volatility, is the EFI index. I talk about it a lot, but the MSCI EAFE index of developed international stocks has the highest two country weightings in Japan and the UK, which may be getting a free pass here on tariffs, and it has no exposure to Canada, Mexico, China, or the US, any of the first-round combatants in the trade war. And that may offer a potential safer haven for investors seeking less exposure to the trade war. So something to think about there as an investment solution there. We've talked for a lot here over the last 2 years on this show about allocating back to international. International is keeping up with the S&P 500 since this bull market began back in October of 2022. And we think there's opportunity there for investors. This is just another reason why I think investors may want to consider that. But you've heard enough from me. Michelle, there's a lot of focus on what's going on wrong, going on incorrectly, terribly in European economies. So it might be a surprise that European stocks are doing well this year. What are your thoughts on Europe?
Yeah, I think this is a little under the radar. People are so focused on the negatives that are happening in Europe and not really noticing that their stocks are outperforming. If you look at the EMU index, that's the MSCI European Monetary Union, that's the Eurozone, it's up more than double that of the S&P 500, outperforming by 500 basis points. And this pessimism is really pervasive, and it's maybe already priced into the stocks. The EMU index is just trading at 18.8 times next 12 months earnings. That's a 35% discount to the S&P 500. And it's important to remember that for stocks, better or worse matters more than good or bad. And recent economic data in Europe has surprised to the upside. We have some other positive catalysts, potentially a new administration in Germany after their elections in a couple weeks that might be less restrictive on fiscal spending, maybe even a ceasefire in Ukraine. And the ECB is still cutting. When the ECB cuts rates, valuations tend to expand. And then if we look at the broader EFA index, the three biggest sectors are financials, industrials, and healthcare. And they represent 50% of the index. And these sectors are also outperforming so far this year. Financials in particular may be a safe haven, just from a sector perspective, because they're not affected directly by tariffs. In the chart here, we're showing, I want to draw your attention to the middle panel. It shows that the percentage of financial companies beating earnings expectations is on pace for a new high, and that could bode well for continued strength. And the stock 600 Europe index, it's up 13% so far this year, just this year. It's hitting a 16-year high. What do you think, Jeff?
I mean, this is a great chart because that's 10 years. So this is the best quarters for companies beating estimates in Europe in 10 years. It's really impressive. And I think, at least, looking here specifically at the EMU. So you said a few things. One, excuse me, we got earnings beats. Very attractive valuations, 35% discount to the US. Usually that's like a 17% discount. So we're really looking at exceptional discounts here in terms of companies in the same industry, much cheaper in Europe than they are in the US with relatively the same global customer base and growth rates. Beating expectations, as you said. Exposed to the right sectors, as you point out, sectors that are outperforming. And as I mentioned earlier, exposed to the right countries. So you really got a lot of things lining up this year. Makes sense that we're seeing double or more than double the outperformance here in those international markets versus the US. So again, something we've been prepping investors for here, talking about our 2025 outlook, where international outperform, certainly paying off so far despite all these risks of tariffs. So are we missing something though, Michelle? Is there a potential positive to tariffs here in the US? Could there be US investment boom as companies that are shielded from foreign competition now begin to invest more in their US operations?
Well, it's a little debatable. The question is whether, we have these uncertainty over policies, and the uncertainty itself could slow business investment and hiring until we get more clarity. And we saw this in 2019. We're showing here, this is the Global Policy Uncertainty Index. You can see an increase. Back in 2019, the uncertainty about tariffs in Trump's first term slowed growth, according to transcripts from the Federal Reserve, because business investment and manufacturing slowed. And then a study by the New York Fed and Columbia University found that tariffs caused an $8.2 billion reduction in real income and also led American consumers and importers to pay the $14 billion to the government. Remember that the importers pay the tax, not the exporters. So, this time where we're really seeing a big impact is in currencies, and the dollar is rising when tariff threats escalate and then declining when threats ease. If the trend of tariffs quickly coming and going continues, economic and earnings impact may be contained, but the longer the uncertainty lasts, the more likely economic growth could slow. And in terms of like a manufacturing renaissance here in the US, some industries, we could get some rebuilding of manufacturing here, but industries that have the countervailing tariffs could end up losing jobs. And companies adding manufacturing domestically could use automation to fill jobs. And then, jobs could be hurt if growth is slower.
Yeah, I guess so. There's the winners and losers, right? And I guess what we've seen in the more recent past with the Trump 1.0 tariffs is that on net, we end up losing more, right? The uncertainty, the higher costs, all those were more of a negative for many businesses than the businesses that were positively affected. So future could be different than the past, but certainly that's what we've seen abroad. It's what we've seen historically and even more recently. So yeah, hard to claim a manufacturing renaissance. Anything can happen, of course, but it seems like again the counter argument to the international outperformance is, hey, this could be a U.S. manufacturing renaissance. We just haven't seen that in the past tied to tariffs in the past. So a big leap, perhaps, but a big leap. Okay, Heather, let's move to. Oh, go ahead, Michelle.
Yeah, I was going to say one thing we didn't talk about is the potential for reciprocal tariffs, and I know you have some thoughts. We saw, we talked about it on the show last week. India, saying they're going to cut their tariffs, and actually later in the week, the EU had talked about maybe they would cut their tariffs as well.
Yeah, I'm going to give you full credit for this one. So you were like, hey, wait a minute. This could actually lead to lower tariffs. Nobody was talking about this. You started talking about this a few weeks ago. And sure enough, that's what we saw, right? So India countered with cutting tariffs. And now this idea of reciprocal tariffs where the U.S. might, say, look, anybody who's charging more of a tariff on our goods than we're charging on theirs, we're going to move ours up. Well, that could just prompt them to lower their tariffs, and then we actually come in with lower tariffs around the world. Now, there's an interesting discussion this morning. So Stephen Miller with Maria Bartiromo, talking about what does the Trump administration mean by reciprocal tariffs? They weren't just talking about import tariffs. They were talking about value-added taxes, sales taxes as well in other countries. And yeah, sales taxes hit U.S. imported goods, also hit domestically produced goods. So, if we're talking about comparing sales taxes across border, I don't think we're going to get anywhere. But interesting to see how this is shaping up, and very complex topic to be sure. But it could, in fact, potentially lead to lower tariffs, as you note, with India and other countries, maybe even considering what could we do. I know there was some talk last week, sort of behind closed doors. Behind closed doors. I mean, they were public that they were saying this, but the outcome potentially could be lower auto tariffs in Europe as a result of the U.S. applying higher auto tariffs. So on European cars into the U.S. So very interesting to see how this could shape up. But yeah, no one was talking about lower tariffs coming out of a trade war, but entirely possible. We'll have to keep our eyes on it. All right, Heather, let's move to chat Q&A. I want to make sure we get to the questions that people have on their minds out there in the chat.
Well, we do have a couple of really great questions, largely surrounding, how do we pick the winners versus the losers? Carol would like to know, with the announcement of tariffs on steel and aluminum, why did we see an initial boost in prices of those stocks, and would we expect that to continue?
So what we saw was a boost to steel and aluminum prices in the U.S. And since those companies, sell those products, materials companies tend to move with the price of the underlying commodity. Energy stocks tend to move with the price of crude oil. And the same thing's true for copper producers, iron ore producers. And so when we saw, we were basically going to be putting tariffs on those products, the idea was, oh, hey, domestic prices could go up. They did, in fact, go up, and so those producers' stock prices moved a little bit higher. The question is, what happens to demand when those prices go up? Do we see the same type of demand, production? Do a lot of the businesses that were consuming that go offshore? Maybe we'll have to see. There are lots of different ramifications when you put these prices on. But yeah, that was the initial reaction that we saw. Some of those producers of those goods go up because the price went up. Again, there's a whole lot more consumers of those goods that may be negatively impacted, and so the net effect could be negative. That's what I mean by winners and losers. There are maybe some isolated winners here that we could look to, but it's difficult to be sure. Even in the case of, hey, it looks like we're going to have, metals tariffs. Does that mean buy U.S. steel producers? Not necessarily, again, because of the demand side of things, because those tariffs could come on and go away again. I'd note that back in 2019, the U.S. applied steel and aluminum tariffs on Europe. 2 years later, they largely went away. They were replaced by quotas. So anything over a certain quota then was hit with a tariff, but not anything below that quota. So they come and go, and so there's a lot of uncertainty tied to those things, and that can create more volatility around those stock prices, and it can also destroy demand, as I mentioned. So it's not as easy. Yeah, there's winners and losers, but they can be very, very short term. So you want to be very nimble if you're trading on that.
Thank you so much, Jeff. Focusing back on Europe, you mentioned that could be a safe haven play while tariffs sort of iron themselves out. Why wouldn't European stocks be impacted by U.S. tariffs since they are so export driven, especially in the likes of Germany? Can you speak to a little more detail on that?
Yeah, so a few things. One is I think that those markets are already braced for some tariffs. We are likely to see U.S. tariffs on certainly selected European products. I don't think it'll be across the board. Could be. I think it'll be more selective. And we've already seen the markets, I think, brace for that, both in terms of currencies and equity prices last year. That's a lot of what we saw in the fourth quarter, positioning for those kind of tariffs. So that's already in there. Second, again, I think we've seen the market react to tariffs and then the tariffs get pulled back. So I think the announcement of tariffs has less impact than it did previously. So European stocks, which are outperforming, if Trump tomorrow announced new tariffs on Europe, could they pull back? Maybe, but probably a lot less than those knee-jerk reactions we saw with Canada and Mexico, because now we know that those tariffs are just the start of a negotiation and they probably aren't likely to be implemented. So a couple of reasons. One, they're already braced. Two, they may not be as bad as whatever was announced. Three, I think they're going to be more selective and therefore could actually lead to lower tariffs, as we talked about with autos. With Europe charging 10% on U.S. cars coming into Europe, where the U.S. only charges 2.5% on European cars coming into the U.S. Of course, totally different story on trucks. U.S. Consumes a lot more trucks and SUVs than they do autos, and we have 25% tariffs on trucks. But anyway, set that aside. We could see those tariffs come down, actually, as Trump tariffs threatens to raise them on the U.S. side on autos. So there are a number of different factors. Again, I think the markets have already priced in to respond to some of those and could actually be relieved a little bit by what comes out of all of it. And Europe has a lot to offer. They can buy more U.S. defense products, buy more energy, and cooperate on a number of different initiatives, including supporting more NATO defense. So all those factors, I think, maybe means the EU is a little further down the list and a little bit less impacted than some of the first round combatants in the trade war.
Thank you so much. And we do have a final question, sort of building on Japan. You did mention they're the top source of foreign direct investment in the United States, according to the BEA. Do we expect foreign direct investment to maybe expand as a way to help navigate some of the tariffs?
Yes, I think so. We've been seeing that in recent years. There's been more regionalization of supply chains. So it's been true everywhere. I mean, there's companies that operate globally are doing less exporting into those countries and more production within those countries. That's generally been true. So more manufacturing in Asia to serve Asian customers, in North America to serve North American customers, in Europe to serve European customers. So yes, I think in general we are seeing that trend take place, and it could be accelerated in some industries if tariff barriers come in higher than expected. That could be true. But again, it's sort of those businesses are still internationally headquartered businesses. So, Nissan, which does a lot of production in the U.S., or Toyota, is still, going to be listed, not in the U.S., but it's going to be listed, in considered an international company, even though it's doing business in the U.S. So the border issue may get more and more blurry. What is a U.S. company? What is not a U.S. company? Even though, they're basically operating in the U.S., may have similar labor forces in the U.S., similar sales and operations in the U.S. One's headquartered in the U.S., one is not. So I think that's the ramifications of all of this, is essentially regionalizations of supply chains. That could be a plus economically for the U.S. As we talked, there are some winners and losers in terms of investment, but from a investor perspective, those companies are still more likely to be in the EFI index that are doing that investment in the U.S.
Hey, Jeff, just, real quickly before we wrap up, there is a question about what are reciprocal tariffs, to the extent you can do that quickly. What does that mean, reciprocal?
I don't know. That's sort of, I put quotes around it whenever I write about it. I don't know. So we'll learn more this week about what they mean. I think the intention is wherever a country charges more on imports of U.S. products and the U.S. charges on imports of their products, that Trump is going to threaten to raise it to the same level in order to try and encourage them to bring it down or just to be fair. I think that's what he means by that. There are certainly some countries, India was one, that had higher tariff barriers. And so again, that could lead to tariffs coming down rather than just tariffs going up to create a bigger wall. We'll have to see what that means and which products are important in all of this. Some are probably more important than others. There are plenty of agricultural and energy and material barriers that countries put in place to protect their domestic industries that would be a whole big can of worms as they affect farmers and unions and just a lot of politically protected groups. So we'll have to see what happens around the world. And bringing value-added taxes into this, as I hinted that Stephen Miller, Deputy Chief of Staff at the White House, brought in this weekend, really raises questions. Sales tax war would be a very interesting one to start around the world. Everybody would start lowering their sales tax. Is very interesting to see what that could mean. I don't think the U.S. is going to raise our sales tax to try and match. Sales taxes are generally applied at the state level. Are we going to see a new federal sales tax? That seems unlikely from a Republican administration, but who knows? So I don't know what it means, and it'll be fascinating to see how that shapes up. Again, I think it's product specific. And may apply to autos. And one of the reasons why I think the market is braced for auto tariffs increasing from the U.S. on European imports. But we'll have to see how that shapes up. We'll be watching it very closely. We'll let you know what the ramifications are. I think they're fairly minor and actually, again, could lead to lower tariffs rather than higher tariffs across the board. I know I keep saying that, but I think it's an important thing that the market's not focused on. So thanks for bringing that up, Michelle. And I wish I knew. We'll find out more this week. Thanks, everybody, for your questions. They're really helpful in making the show better. Let us know what you think about the show, by the way, in the comments, in the surveys, how we're helping you, if we're helping you, what else we could do to help you out. Thanks so much for that. We really appreciate the feedback. And thanks, Heather and Michelle and our producers, Andrew and Gabe. Please tune in each week at 11 a.m. Eastern or catch the replay on YouTube. And also be sure to click like on the show and share your comments on what you're watching in the markets. And we'll see you next week.